Hi there, it's Carl Allen back with you for your daily bite-sized video training on buying businesses and deal making. So the topic I want to cover today, and I get asked this a lot, is Carl, how do you make money from buying and selling and flipping businesses? So traditionally what we do is we go and buy a business, no money down using leveraged finance, so it's a leveraged buyout, and then we grow that business, we improve that business, and then we sell it in 3 months, 3 years, however long it takes to sell that business and make money. So that's the classic way that you make money from doing these types of deals. You buy them effectively for free because you're not using your own money, and then eventually you sell that business and that's your payday. That's the money you get when you sell that business. So that's the biggest way that you'll make money from doing deals. The second way that you make money from doing deals is once you buy a business, as you're growing it and scaling it and improving it ready for sell, which is the big payday, then because you own the business, all the profit, all the cash flow that the business generates is yours. And there's lots of different ways that you can take money out of a business in a tax efficient way rather than taking it out as normal salary and paying the higher taxes that you will typically find either in the UK or in the US, Canada, Australia, where most of our deals are being done. So that's the second way. As the owner of the business, you own the cash flows. It's your business, so you can take that cash flow out, you can spend it, invest it, do whatever you want to do. The third way that you can make money out of doing a deal, and this happens typically kind of 1 in 10 times, it depends on the kind of financial profile of the deal. But in some cases, if you're making a closing payment or you're not making a closing payment, doesn't really matter, and you're able to raise finance from the balance sheet of the business, from the assets that are in the business, like the accounts receivable, the trade debtors, the stock or inventory, the real estate, the fixed assets, the plant and equipment, whatever they are. If you can raise more money at closing than what you need to pay the seller and pay your closing fees, which, as you know, are all contingent after the deal's been done, if the amount of money raised is more than the amount of cash that then leaves the deal to pay everybody, then that delta, that surplus, if you want it, can be yours. You can take it out, you can go on vacation, you can buy another house, you can do whatever you want to do with it. I, however, don't do that. I keep that money in the business to grow it. So it's additional working capital. So I can hire more people to grow, like salespeople or marketing people. I have a bigger budget for marketing, for advertising, for Facebook ads, or however we're scaling the marketing inside of the business. We might buy new equipment. We might do a whole bunch of other different things so we have a larger budget. So I'd rather keep that money in the business to grow, because then guess what? I get more cash flow per month as the business grows to take out, which was the second part of how we make money. And then also, the larger you scale the business, the more revenue it's got, the more earnings it's got. That means it's more valuable when you sell the business later on. And it's more valuable, you'll get more money for when you sell it. So you might take $100,000 out of the deal the day you buy it, that's great, but that $100,000, if you use it in the business, could generate $1 million of extra value when you sell the business going forward. So those are the 3 ways that we typically make money out of doing deals. The fourth way, if there is a fourth way, is once you've bought the business, if you did wanted some additional working capital or you did want to take some money out, you can sell some of your equity. So you might sell 10-20% of your equity to employees or an investor, an angel investor, a crowdfunding platform, whatever. So that's another additional way that you can take money out of the deal. But the 3 primary ways are cash when you exit, which is the biggest, cash flow, per month, per quarter, per year, however you want to do it, as the owner of the business, as the owner of that cash flow. And then the smaller amount is any surplus cash from the financing that's higher than the amount of money you need to pay the seller at closing and your closing fees. So those are the 3 primary ways that you can take cash out of a deal. Hope you found that useful. I will see you on the next video. And until then, bye for now.